just sitting on your desk today.
Right. That would be nice.
Yeah, but you don't just read it to see who won the big game or what the stocks market did. You use it to quietly log on to a website and place a $400,000.
But honestly, when you have millions of dollars just sloshing around in these largely unregulated digital markets, reality tends to outpace fiction pretty quickly.
You use it to... Well, welcome to the deep dive. Today, we are staring down a massive stack of your sources. We've got federal indictments, market analysis, our own research notes, and specifically this really fascinating snapshot report from the prediction market industry. It's dated Friday, April 24, 2026.
Yeah, that specific date
Well,
is
welcome to the
super
deep dive.
important.
Today, exactly. Our mission for this deep dive is to basically unpack how platforms like Polymarket and Kalshi are operating right now. They're in this state of extremely high friction and just record-breaking volume. We're looking at how they're acting as these real-time crowdsourced barometers for literally everything. I mean, from high-stakes geopolitics to the actual price you're going to pay at the gas pump next week.
Right. And what is crucial to understand about the sources in front of us is that this date, April 24th, it really represents a massive turning point because for a long time, prediction markets were just viewed as like niche internet curiosities, you know?
Yeah, like a place where political junkies would bet $50 on an electoral map or something.
Exactly. But that era is totally over. Today, we are looking at an industry handling billions of dollars, and we are witnessing the severe, very public growing pains of that evolution in real time.
Okay, let's unpack this, because we really have to start with the most explosive piece of source material in the stack today. This is the headline that is actively threatening the previously unregulated kind of Wild West nature of these offshore platforms.
Oh, the federal indictment?
Yeah. Across the entire ecosystem today, the #1 trending topic is the unsealing of a federal indictment against an active-duty U.S. Army Special Forces soldier.
And, I mean, the specifics of the charge are just unprecedented. Prosecutors are alleging that this soldier used classified insider knowledge of a military operation that took place back in January.
Right, the one designed to capture Nicolas Maduro.
Exactly. The soldier allegedly took that classified operational knowledge, went right onto Polymarket, and reaped over $400,000 in profits.
It's just wild. I keep thinking about the movie Back to the Future Part 2.
Oh, with the sports almanac?
Yes. You've got Biff Tannen, and he gets his hands on this almanac from the future. He knows the outcomes before the games are even played, so he just places bets and gets rich. This soldier was basically acting like a geopolitical Biff Tannen.
That is a great analogy, actually.
He had the answers to the test because he was part of the military apparatus executing the event. But I'm kind of stuck on the logistics here.
Yeah.
Like, how does someone pull off a $400,000 bet on a highly classified military opera without immediately tripping, every single security alarm on the platform?
Well, what's fascinating here is the actual mechanics of how liquidity and order books work. Because on a typical platform, there isn't just a giant pool of money sitting there waiting for you to win.
Right, it's peer-to-peer.
Yeah, you have an order book. It's essentially a list of people willing to take the other side of your bet at various prices. So if you dump $400,000 into a market all at once...
You just instantly crash the odds.
Exactly. You crash the odds, and it is a massive red flag. So a skilled trader will use a technique called layering.
They break it up into smaller, less suspicious chunks.
Exactly that. You buy $5,000 here, you wait an hour, maybe buy $10,000 there. You try to blend in with the normal background noise of the market. And historically, because a platform like Polymarket operates using cryptocurrency, traders felt they had this, veneer of anonymity.
Because they aren't using their real names.
Right. They are using cryptographic wallet addresses, just a string of numbers and letters.
But this federal indictment blew right past that anonymity.
Because the inherent nature of a blockchain is that it's a public ledger. I mean, it is a permanent, unalterable record of every single transaction ever made. You might be operating under a pseudonym, but your financial footprints are permanently burned into the digital concrete.
Wow.
Yeah, the federal government didn't even need to break into Polymarket servers. They simply looked at the public blockchain, found the wallet making suspiciously perfectly timed bets on military action, and just followed those digital breadcrumbs right back to the point where that crypto was converted into traditional US dollars at a normal bank.
That is incredible. And the shockwaves from those breadcrumbs are highly visible in our snapshot today. Over on Kalshi, which is a fully regulated U.S. platform, their regulatory action markets spiked by 40%.
Yeah, that was a huge move today.
Traders are suddenly pouring money into bets on whether the Commodity Futures Trading Commission, the CFTC, is going to step in and impose mandatory Know Your Customer, or KYC, rules for all global geopolitical contracts.
And that KYC element is the existential threat to how these offshore markets currently operate. Because Know Your Customer basically means you have to upload a government-issued passport or a driver's license before you can even trade.
Which totally defeats the purpose for a lot of these crypto traders.
Right. If you force every single trader betting on a global conflict to prove exactly who they are, the pseudo-anonymity vanishes instantly.
And we're already seeing the chilling effect. The report notes that Polymarket's war footing and political coup categories are seeing a severe liquidity dip today. The money is just drying up.
Totally. Traders are clearly waiting to see if the Department of Justice is going to target other high-frequency accounts. Consider the perspective of a market maker for a second.
Okay.
These are the institutional players, like the algorithms and quantitative firms, that provide the millions of dollars in liquidity that actually allow these platforms to function. They make their money on tiny fractional fees from thousands of normal trades. Suddenly, they wake up today and realize they might be taking the other side of a bet against someone who has, classified nuclear launch codes or troop movement data.
So the playing field isn't just uneven. It's potentially illegal.
And highly unprofitable. I mean, if you are a market maker, you cannot mathematically price in the risk of classified military espionage, so you pull your cash off the table. The smart money is fleeing the geopolitical markets because the risk of DOJ entanglement is just way too high.
Wow. Well, money's like water, right? It always flows to the path of least resistance. If the DOJ is blocking the geopolitical pipe, that capital has to go somewhere. And according to our snapshot, it's flowing right into domestic political bets.
It really is.
Specifically, it's flowing into the highest volume sector of the day Washington gridlock.
Which is a very logical pivot if you think about it. If foreign markets carry the risk of insider trading indictments, you move your capital to a domestic market where the variables are entirely public and televised every single day.
Yeah, that makes sense. And the numbers on Kalshi are just staggering. The market for a government shutdown lasting at least 100 days, which would drag this out all the way into June, that just hit a new all-time high probability of 58% this morning.
58% for a 100-day shutdown? That's bleak.
And it gets starker. The odds for the Department of Homeland Security, the DHS, being funded before May 4 have effectively hit 0%.
Zero.
Yeah, zero. Following reports that the Senate just adjourned again without a formal floor vote, that specific cluster of government gridlock bets became Kalshi's domestic leader with over $18.1 million in volume.
That is $18.1 million of concentrated market sentiment, signaling that traders have absolute zero faith in DC's ability to reach a compromise anytime soon.
I want to push back on the mechanics of this, though. Let's just look at this impartially for a second. When we talk about $18.1 million riding on the government staying closed, at what point does that volume actually influence the outcome?
That's the million-dollar question, isn't it?
Right. If millions of dollars are being made by the government failing to open, do the financial incentives of these prediction markets actually discourage a resolution? Like, are traders actively rooting for a shutdown to protect their positions, or is this simply a grim reflection of what's already happening?
Well, that is the philosophical tightrope we are walking with the rise of these platforms. But if we look strictly at the financial mechanics, what we are really seeing here isn't manipulation, it's trader capitulation. When the DHS funding odds hit a flat 0%, it represents the absolute stripping away of political spin.
Help me connect those dots. How does a 0% market probability strip away spin?
So think about traditional political polling or, watching a press conference on a Friday afternoon. Lawmakers will stand at a podium and say, we are working around the clock, a deal is imminent, we are making great progress.
Right, the usual talking points.
Exactly. Those public statements are designed to manage optics and soothe the public. But prediction markets are entirely agnostic to optics. They only care about capital allocation. When the odds hit 0%, it means the market has collectively looked at the structural reality. The fact that the Senate actually adjourned and went home for the weekend, looked at the calendar, and decided that any political rhetoric about an early May 1st resolution is fundamentally disconnected from reality.
So it's essentially a crowdsourced lie detector powered by millions of dollars. You can say whatever you want at a podium, but the market knows you aren't actually in the building to vote.
Yes, it cuts through the noise because the traders voting on these outcomes have real financial skin in the game. They are financially penalized for believing political rhetoric that doesn't match physical reality.
Here's where it gets really interesting, though. We're transitioning from the total paralysis of DC to the absolute warp speed of the tech world. Because while the smart money is pricing in domestic gridlock, they are also turning these platforms into massive, crowdsourced magnifying glasses for corporate risk.
The contrast in the data today is striking. Gridlock on one side, hyper-innovation on the other.
Yeah. So let's talk about Elon Musk and SpaceX. According to this snapshot, SpaceX officially filed a prospectus yesterday, April 23, for its highly anticipated IPO. The reaction on Kalshi was instantaneous. The market for an IPO announcement before July 1 surged to a 91% probability, which, is basically standard financial news.
Right. A 91% probability indicates supreme confidence from the market makers.
But the 91% probability isn't even the fascinating part here. Hidden deep within the hundreds of pages of that SpaceX prospectus were various corporate warnings and risk factors. And because these prediction platforms exist, a totally separate side market immediately emerged.
Oh, the XAI market.
Yes. Betting on whether XAI Musk's artificial intelligence company will lose market access due to harmful imagery investigations.
If we connect this to the bigger picture, this represents a phenomenal evolution in how financial research is actually conducted. Historically, an SEC prospectus is a dense, legally complex document. Maybe a few dedicated Wall Street analysts and some specialized journalists read it cover to cover.
Right, which is why I'm struggling to understand why thousands of retail crypto traders are suddenly reading dense SEC prospectuses. Are they actually sitting down with 400 pages of legal jargon, or is there like some algorithmic tool doing this for them?
Well, some of it is algorithmic scraping, certainly, but a lot of it is pure human incentive. It's basically weaponized reading comprehension.
Weaponized reading comprehension. I love that.
Yeah, because in a traditional stock market, if you find a hidden risk factor in a prospectus, it might take months for that risk to impact the stock price. On a prediction market, if you find that footnote first, you can instantly buy shares in a specific outcome for 5 cents. When the rest of the market catches up and realizes the risk is real, the odds shift, and you sell those same shares for 50 cents.
So they are financially gamifying the fine print. You have an army of retail traders combing through a boring legal filing, not because they care about the regulatory law, but just to find a profitable side bet before anyone else does.
And in doing so, they provide a real-time, crowdsourced probability of how dangerous those AI safety investigations actually are to the bottom line of these massive tech conglomerates. They are doing the due diligence that traditional analysts might overlook, simply because there is an immediate financial reward for being the first to spot the hidden risk.
That is wild. Okay, so we've covered billionaire tech conglomerates. We've talked about military espionage. We've talked about Senate gridlock. Let's follow the volume and bring this home to Main Street. Because the snapshot reveals some massive signals regarding the listener's daily life, their wallet, and quite frankly, their summer plans.
This is where prediction markets cross over from abstract financial concepts and SEC filings into unavoidable kitchen table realities.
First up, Kalshi just launched a brand new commodities hub. It's a dedicated interface for betting on gold, oil, and lithium with 247 pricing data. And immediately, all the focus is on oil.
Oh, definitely.
Due to the ongoing crisis in the Strait of Hormuz, the market for WTI crude hitting $115 per barrel by May 1st has reached a 65% probability.
We really need to define what that actually means. WTI crude is West Texas Intermediate. It is the underlying benchmark for the oil that eventually becomes the gasoline in your car. A 65% probability for it hitting $115 in just a week's time is a glaring red flashing light for the global economy.
So what does this all mean for you? If you are listening to this right now while, planning a summer road trip or just budgeting for your grocery run, this 65% probability isn't just numbers moving on a screen. That is a direct, hyper-efficient early warning system that your travel budget is about to take a serious hit.
Yep, it really is.
It is predicting the pain you're going to feel at the pump before the local gas station even changes their signs.
And that's the thing. The commodities market on these platforms isn't just an arena for traders to speculate. It functions as a real-time forecasting tool for everyday Main Street inflation. It basically tells us what the cost of living is going to be next month.
But I'm looking at the final page of this April 24 snapshot, and the volume numbers tell a wildly different story about human psychology. Because that warning about inflation and gas prices, it is completely dwarfed by the sheer tsunami of money flowing into sports.
The disparity in capital allocation is almost comical when you look at the raw data.
Listen to these figures. The Oklahoma City Thunder, are a 50% favorite heading into Game 3 of the NBA playoffs. The volume on that single market, $231 million.
That is insane.
Over $250 million riding on one basketball game. And it gets bigger. The 2026 World Cup is still 2 months away. No one has kicked the ball yet. But the World Cup winner market on Polymarket has already exploded to $529 million in volume.
$500 million.
$500 million. By the way, for anyone planning their summer viewing, Spain is trending at 16% and France at 13%.
It perfectly illustrates the dichotomy of this specific moment in the industry. You have massive retail enthusiasm throwing $500 million at a soccer tournament for pure entertainment. It is recreational capital.
I have to ask why, though. Like, why is a basketball game pulling in over $200 million while the global oil benchmark, which dictates the actual global economy, is seeing a fraction of that?
Well, it comes down to the mechanics of capital efficiency, specifically something called liquidity turnaround. Retail traders, the everyday people using these apps on their phones, they want fast resolutions. They want the dopamine hit of a quick outcome.
Makes sense.
Yeah, if I bet on a 100-day government shutdown, my money is locked in a digital vault for 3 months. I can't use it. If I bet on the Thunder game, the market resolves tonight. I get my payout, and I can use those same funds to bet on something else tomorrow morning.
I see where you're going. The barrier to entry for sports is just way lower, both in terms of time commitment and required knowledge. You don't have to read a 400-page SEC prospectus to have an opinion on an NBA playoff game.
Precisely. The general public is focused on the fast-paced entertainment value, essentially treating these powerful forecasting platforms like a traditional sportsbook. But the crucial structural signals, the ones dictating the cost of living and geopolitical stability, are coming from the slower, more deliberate, smart money navigating the commodities hub and, dodging the Department of Justice.
It is a profound split screen. And it brings us to a really clear synthesis of what we've unpacked from this stack of sources today. Because this single date, April 24, 2026, it really serves as a monumental turning point.
It absolutely does.
We are watching an entire industry try to balance the massive, unbridled retail enthusiasm for things like the NBA playoffs and the SpaceX IPO against a sudden, very cold reality check from federal prosecutors handing out insider trading indictments. Not to mention the grim reality of a 100-day paralyzed government.
It is the moment the prediction market industry officially has to grow up. The stakes are no longer just internet bragging rights or niche economic theories. They involve federal prison sentences, mandatory KYC regulations, and massive indicators of global inflation.
It touches every single part of the economy. Speaking of which, before we wrap up, I want to ask you, the listener, a direct question. With the SpaceX IPO now officially in the works, based on the prospectus we analyzed today, would you like us to track the specific opening price or the first-day valuation markets for you as they go live? Let us know, because watching how the crowd prices in a company that launches rockets is going to be a fascinating real-time case study.
And as we continue to track all of this, it raises an important question, one that wasn't explicitly answered in the snapshot report today, but that we all really need to be thinking about moving forward.
What's that?
If we have reached a point where tens of millions of dollars are riding on whether an AI company faces federal investigations or whether the U.S. government stays shut down for 100 days, at what point do these massive global prediction platforms stop just forecasting the future and start actively incentivizing people to make those events happen?
Oh, wow. You're talking about crossing the line from observation to creation. If there's $500,000 waiting for someone who can ensure a specific footnote in a tech prospectus becomes reality, eventually the market doesn't just show you what's coming. It pays someone to build it.
Exactly. A very unsettling thought to leave on.
We'll see you next time.